Hey folks, as we're ending 2021, the first quarter, and as now we're getting into mid of April, and many of the markets participant has actually been touting out and saying that the market is getting extremely overvalued. And of course, when it comes to this, the next question is always what they ask is, what should I do now? Now, there's nothing to be panicked about, and let's do a deep dive into what is exactly happening in the markets. Now, when we say the market is overvalued, the first thing we take a look is the broad market PE ratio. And this is where we take a look at the S&P 500 PE ratio. And of course, and this is measured over 100 years of PE ratio, where you can see there are different measures of valuation right here, and it has been actually considered 15 I mean at the number of 15, it's considered a fair value for 100 years ago up to today. So now as it is getting above 20 or even 30, right now it's above 30, which is extremely overvalued. And this is where the fear comes in, where most of the market, the investors were asking. Now we are very near to the tech bubble crash, where the market is very overvalued at that time, and it's actually at around 46. And we are now in the mid of April. The latest PE ratio is around 41. Now, of course, if you talk about subprime, that's way beyond the chart and is around 120 at a time. So we won't be referencing that too much. And we're just comparing to the nearest ratio here. We're in the red zone right now. And but how we actually, what are the actions that we are required to take, or we don't do anything at all? So, but of course, that's not the answer right now. Let's go a bit further. Now, if we look at the S&P index and how far have we recovered from the crash? And it's almost a year plus, almost 13 months. And from the bottom of this pandemic crash up to now, it's around 90%. And at the same time, we are in the very bullish month or season right here. And this market, the price action right here in the broad-based market, it's actually quite overextended, all right, at this part. And this is where I do not want to add shares at this moment. So what I would do is that I would wait for the price to slam down between 10 and 15% of the correction, all right, before I buy more more undervalued companies or great companies at maybe in a few months time, because we might not know when is the next correction. But right now it looks very overextended, and these moving averages, they act as a gravity. So if this price goes way too much far from the moving average, then it pulls it back and it starts to retrace after that. So you can see that the moving average, they act as also support. See, it bounces off there, then it bounces off around 100 level or even at this level before it starts waving upwards. All right. So see, it reacts to moving averages. Right now, we are very far apart, and it's like, hey, it's time to come back to the earth. You've flown too high to the sky or even to the moon. Right. So now, as we're saying that we are in a very bullish season, then I would like to show that in Thinkorswim platform, you can actually plot, let's say, for instance, a ticker symbol, let's say S&P, and you can do it for an average 20 years history, and it plots out the average of 20 years price action for S&P. And when you actually plot that, and of course, what we can see here, we can see the most bullish month starts from October. All right, I have some statistics right here, which is about 65% of the time is bullish on October. And of course, November is considering for the past 20 years history has 84% bullishness. And these are the three most bullish months where most investors were looking to buy at this correction a lot before the market starts to rally. All right, so a lot of people call this year-end rally. and it rallies all the way to April, which is April is also one of the most bullish months of the year. And you can see the average movement is quite parabolic at this time. And then in May, which is actually right at this part here, they have a saying where they always call it sell in May, all right? Sell in May and run away, all right? So of course, if you're holding strong fundamental stocks, it's not much to worry. It's just a time where between May, June, July, August, and September, these are very volatile months, and this presents opportunity to reaccumulate again before the next bull run at the end of the year. All right, so well, all right, so now just to keep things simple, you can actually look at the statistics below here. It's compared within 20 years, the bullishness of of this of the months that is stated right here, the numerical values. All right. So now, if we look back, rewind here a little bit in the index, and this huge rally right here reminds me of 2017. And if we go back to 2017, we had a long bull run without any huge correction or any correction that's beyond about 10%. So in the beginning of the year, let's say about 2018. All right, so here then it's quietly moving out. It's bouncing at the moving average. So it's quietly moving up until one point it starts to get further and further away from the moving average. And when it gets so far away, and this is so unsustainable, any price movement that moves in such a fashion, let's say for instance it's waving upwards, then suddenly it flushes upwards or surge upwards, and this is where it has the highest probability to have a strong pullback or a very deep correction before it starts to continue the trend again, or it might start to consolidate, right? Like in 2018, uh this part right here, it's 2017 if I can recall. Then this part right here is 2018, and this is where you have like a trade war going on between China and US. After this drop, a huge drop in January, right, which is an 11% correction. So then you have very volatile markets after that. All right, so now, all right, always remember the most important thing is actually this part, which is going up very, very steep. And what I may anticipate is this part right here, a huge correction. All right. So we might not know when, but it may happen sometime. So now let's plot the S&P PE ratio against the index. And what we can see in the past, like let's say for instance, this is the tech bubble crash. And what we can see is that during crashes and recessions, all right, crashes and recessions, index price crashes, but the PE ratio increases. So we can see PE ratio rises, price decreases. Now this is because companies, whenever there's a recession, there's less sales and there's less room for earnings. So while having high prices, the market corrects itself. And of course, when people stop spending during the recessions, then you have very huge problem for the companies to make earnings or revenue. Therefore, sending a high valuation, sending the PE ratio upwards, making it overvalued. All right. So now same goes for the subprime, and what we can see here is that the prices of the index starts moving downwards, and the PE ratio starts surging upwards. Now this is way, way, way high, and it's within a century. This is the highest. It's around 120, and of course we've never seen this over 100 over years. We've never seen this in the actually PE ratio. All right. So now what is different in this time is the crash is very, very short. It's in fact the shortest, almost the shortest in the history, and the recovery is the fastest in the history. So now with a lot of QE and stimulus, and what we can see right here is that both the PE ratio and the price is going upwards. And this is what we call, in theory, It's like if you just buy up treasury bonds and I mean if the Federal Reserve or the central banks, if they buy up the stock market and they buy up the treasury bonds, that we will call pushing the string. So imagine if you have a string on the table, and if you push the string, what happens to the string? Then the string starts to curve, right? So they think that way is not enough. What they need is something that, like what Australia has done, is that for the past 27 or 30 years, they have not had a recession. Is that because they have actually banked in stimulus checks to individuals so that they could spend money. All right. So when they have money banked into their account, they would spend the money, and that would drive up the company's sales revenues and the earnings. So that we will call pulling the string. All right. So you got to push the string and to pull the string in order for the string to become straight. All right. So this is what exactly we would anticipate if they pull the string hard enough. Is that we would see the, if the companies are making more revenues and earnings, then we will see the PE ratio normalizing or going downwards again. All right. So well, but of course nobody can predict what happens next. That's uh, that's something that I would anticipate. All right. So now another measurement is what we see in the market besides PE ratio. We want to compare which is the most attractive market for us to invest in. Now let's say for instance, there's always the big, I mean, a comparison between uh, I mean, investing in bonds or the risk markets, or we call it equity risk market. So this comparison here, this chart is was actually published in April. I think it's around 14th of April this year. And what we can see here is that the S&P earnings, 500 earnings, which is, we call it equity risk premium. In short, most people would call it ERP, all right, versus the risk-free rate, or we compare it with the U.S. Treasury 10 years bond yield. So which is now about 1.6 or 1.54 actually in the latest in the latest price, in the latest market measurement. Right. So what we can see here, the most important thing is that this, if you take 3.54 minus maybe 1.5, right, on the 10 years of treasury bond use, and we still get around 2, all right, 2%, which if you invest in the equity markets, by just looking at the earnings yield, you still get a positive return. All right. So this is equity risk premium. Equity market still remains more attractive in this case. And if we compare it to the inflation rate, uh, also at the same time, it's actually having a more, it's positive compared to inflation rate. All right. So the blue line is still above the red color line. And in fact, this inflation rate is even higher than the treasury bonds. If you invest in treasury bonds, then hell, you're losing money to the inflation rate. So at this moment, for valuation purposes, I would say this is still more attractive at this moment. All right. So although you can see the PE ratio is very high in the markets, that worries a lot of people. Right. So now another thing to look at in the market is that also to look at the yield curves, and this is very much related to the bond. If you measure the short-term bond use and the long-term bond use, then for us to say if the yield curve, if it is positive, positive, all right, that means they always compare the 2 years and the 10 years. That means the 2 years yield is lower than the 10 years bond yield. All right, and this is considered normal and it is time to become greedy. All right, or it's time for investment. But of course, this is where we have to look very carefully. If the yield curve is normal, coming from a cycle of from inversion to normal, doesn't mean you have to buy immediately in the markets. You just have to get ready to buy, not to buy immediately. But I'll tell you why later. All right. Now, of course, now I look at this like traffic lights, and if the yield curve becomes flattening, which the 2 years yield is almost the same as 10 years yield. So when it's like a moving to a neutral gear before before you have an inversion. And this when you have inversion, that means it's extreme fear. More investors are actually buying into a 10-year bond when they're exiting the risk markets. So this is when they feel very risky in the equities and they start to move their money or rotate the money into fixed income or risk-free assets, right? So when you buy more bonds, then you drive the bond prices up. At the same time, when you buy the bond prices up in relative, I mean the yield is actually an inverse relation to bond prices. All right. So when they buy more bonds, then it suppresses the yield. The yield goes down. But then, if the economy overheats, then the Federal Reserve would actually increase the short-term or increase the interest rate, therefore also increasing the two-year bond yield. Okay, it can influence this area, the left side of the chart. So when this goes up as the market's overheating, when they have high inflation, then the investor starts to move out from the risk markets, turning this belly up. All right. But of course, if you see inverted yield curve, then that doesn't mean you must sell immediately again. So it depends on how the market is reacting and how the price index is actually behaving. All right, so we cannot use this indicator to buy and sell immediately. Right? It is. I mean, it may be known as as a leading indicator for this, and if we look at how far it is, let's look at the previous month. I mean, sorry, not the previous month, but the previous crashes. How long it takes for the market to crash when the yield curve inverts. Now let's go. If we look at point number one, the bubble number one, that's when you have a tech bubble. And of course, to compare tech bubble, the best part to compare is to look at Nasdaq index, not in Dow Jones. All right, but I'm just using this as a hypothetical comparison. Is that when you have yield curve inversion at this area, all right, when the two-year yield is higher than 10 years yield, then what you can see is that the market doesn't make a higher high and price is weakening. It doesn't trend upwards anymore. So, and then when it starts to crash, all right, when it starts to crash, what we can see right here is that the yield curve starts to from inverted yield curve, then it becomes flat or steep, becoming back to normal when it comes to point number two. You see, it's pretty fast. You see, when the market is crashing, the investors they start to actually move their money back into the risk market or getting ready. So as they start to sell their bonds, money in the bond market, then if they sell their money in the bond market, what happens is that the bond prices would fall. Bond prices would fall, and what happens to the bond yields? Then the bond yields would rise, and this is where you see the bond yield starts to steepen, and the Federal Reserve very dramatically, whenever there's a crash happening, and if the market crash is happening, the Federal Reserve or the central banks will start to lower the interest rate very dramatically. So when they start to lower the interest rate, then they will actually influence the left side of the yield curve. So it will bring it down dramatically. So at this part, point number two, where you have this bracket right here at this time period. Right. So let's delete that off. Now moving to point three, and this is where we feel the most comfortable, where you have a normal yield curve or positive yield curve, and this is where probably you can even that's a period for you to invest, which is right. Of course, you need to see when the market's bottoming. There's other factors that you have to look at. All right, so then of course it lasted only for a few years, from January 2002 to August and 5. Then slowly, when we see the market starts to actually overheat, and this is where the Federal Reserve would start to increase the short-term. Increase the interest rates, so it affects the short-term bond yields. So this goes up. All right, so it starts flattening, and this is where we have to become cautious. If this happens, like let's say it goes to even the January 2006, and this is where the yield curve starts to invert around somewhere here. and it takes around maybe about 18 months, 1.5 years before the market tops. And this is where it gains about 32%. After the yield curve inversion, the first day, officially, before it goes up here, I mean, before market tops, it's around 30, it has 32% gains before it starts normalizing again. All right. So we don't sell whenever we have a yield curve inversion, but it's a leading indicator telling us that we have trouble in the economy. All right. And this is where the top here, and this is where it starts become flattening to steep very fast from point 0.6 to point 0.7. It's very compressed time. And when it comes to point 0.8 again, then you have a very normal yield curve. Right. Then you have like a from here you have like a 10 years rally from year 2010 all the way to pandemic 2020 from here onwards. Right. So now that's a little bit of history for you. And of course, there are many ways to track this, but I would not cover this in full extent. And because I would like to keep it short, and let's say for instance, and this is one of the tool. I mean, this is one of the tools that you can access into stock charts. And this is a simulator where you can actually drag this line. Let's say all the way to the tech bubble. Okay, this is a tech bubble. Before it crashes, you can see that the yield curve has inverted. You can see this. You can see right here in the 2 years yield all the way here. It's almost the same or higher than the 10 years yield. All right, here. So now right before that, then you have huge market crash right there. So this is like a predictor of recessions. All right, ever since 1970s, it has been about 5 or 6 times. So yes, you can see then when the see as the market crashes, the yield becomes more like steepening. As it's moving downwards, then you have also this short-term bond yields going down. It's because the Federal Reserve, in parallel with the crash, they start to reduce the interest rate dramatically. So influencing, suppressing these yields down here. All right. So now, again, as the market starts to become, time to invest again, this is like time to become greedy again. So you can see the yield curve starts to, slowly, as the market's overheating, slowly the short-term yield starts to rise, right? So as it rises, then this is the part where you have like, okay, this is the part where somewhere around, I think, November 2006, then you have your 2 years yield higher than 10 years, all right? So it's somewhere here. So then, of course, it takes maybe, let's see, when September 10, all right, November 2006 to September 10. So, of course, before that, we have another tool. You look at trading view, you can compare that even more accurately. All right, so I think it's about 18 months before it crashes before it goes to the market top, then it crashes. So you can see that while it is crashing, you can see that the yield curve starts to become normal. You see, you can see the short term, this part starts to move down dramatically. All right, as the Federal Reserve starts to actually reduce the interest rate again dramatically to actually encourage more stimulus, or a more encourage more spending in the economy on low interest rates or more borrowings. Right, then you have another new cycle starting up, and this is like a secular bull, we call it. So it has been actually staying, all right, it has been staying very normal for many years, up to 2017 and 18. And that's 2018. All right, this is where we see the yield curve starts flattening. And this is quite worrisome for most investors because it has been a long time the market hasn't had any big crashes. So then we reach to pandemic. All right, this is the part where pandemic. Then again, we have recession, and recession often triggers the Federal Reserve to lower interest rate, and that's where you have again. This is like so flat; it's like almost down to zero, and then you just have the 10 years yield with a very small spread against this. So again, we have another new bull market triggered right here. So there you go. So this is the latest yield curve. All right. So now back to our materials. Okay. Mhm. So of course, like just now, what you have seen is that the purple color part. All right. So this is where we are. We have this is slammed down the straight flat on the floor, right? And then you have a normal curve, which is positive, which is quite okay to stay invested. And as you notice, if you look at August 2002, that's like the bottom of the market, and you can see this is the yield curve, right? And then after subprime crash, and this is the bottom of subprime crash in the market. This is the yield curve. So every time the market crashes, what I notice now is that you have the normal you have normal yield curve, but it's always lower than the previous ones. All right. So the other two is just an example where actually I extracted most all the data so that I can plot this yield curve to take a look what happened when it start inversion. It starts its inversion like before subprime crash you have like October 2006, and this is how exactly the shape of the yield curve looks like. You have two higher than 10, of course, with very little spread, right? It's not always like PAM like that, right? So, okay, all right. I won't go too deep into this, but you get the idea how the market reacts to dynamic yield curve, all right? Okay, interesting. And this is also one of the two that you can access in FRET, St. Louis FRET, and this is the mathematics they have already done for you. So they take a 10 years bond yield and 2 years, they minus the 2 years bond yield. Then you have like, this is like the zero threshold. If it's like above zero, then it's positive, right? And if it's below zero, it's inverted, or you call it negative U curve, right? So you see, it started the U curve inversion started here, then it goes back to normal, then it comes back here, very deep, and then you have recession, which is the gray shaded area. See this area. But you see, during recession, because the Federal Reserve starts to lower the interest rate dramatically, and your 10 years bond yield, let's say it stays this way, then the 2 years bond yield that start to go down like that. So you have a huge spread rapidly happening right here. All right. But of course, that can be plotted in other charts. Then, well, the very most that it goes up to, the differences between the 10 years and the 2 years bond yield is about probably a 250 basis point tops. All right. Like, and after that, you have subprime. You have inversion, yield curve inversion right here. Then you have recession after that, right? It's a predictor of recession. So nothing. This is not even inverted. Probably just 1 or 2 days. All right. It's not really that such. Significant. Then what you can see is that around this time, a lot of investors has actually mentioned that the 10 years you bond yield has been actually rapidly increasing, and it worries them. It's so fast that it's surging so fast that people are actually worrying a bit here. But it still has some room to go up. You see, up to this 250 basis point. Yeah, we have some room before it starts become wobbly, like the ones over here right after the recession. All right. So see, market goes in cycles, sine waves. Right. So, well, let's put this in summary. Well, what I do is that, see, very first we equate this. When we want to see whether it's positive, we took the values. 3.54 minus 1.64, yes. 1.9 is still positive, checked. Equity risk premium versus inflation rate. Well, it's still better than holding cash. So holding cash is a lot of people say cash is trash, right? So all right, here you have still positive, and the yield curve is also still positive. All right. So, well, I would like to remain bullish at this moment, given all these factors. And also, I would like to thank you for your time, for staying with me. Stay tuned, and if you'd like to join our group, please go into U.S. stock trading and investing in the Facebook. It's a private group, and you can click here. Then we can actually look at whether whether to approve. All right, if you're serious about investing, you can join our group. And also we are opening up a page. This is a page where we call it Marksman Capital. Well, you can also follow our page. We just started this not long ago, right? Okay, so thank you for your time and see you again.